Welcome back to another video. Today we are going to cover stop loss. To be more specific, we are going to cover some of the setups that I have in this book to be specific, where we learn to understand exactly where to place our stop loss. And in this video, we're covering only buying sessions, different variations of buying session, and where exactly you should place your stop loss. And these setups that I have on this board that we're going to be going over today is going to be simply based off this book, every single one of them. All right. So these setups themselves are straight from this book. So ultimate stop loss now available to you for you in Amazon. Just type in Royalty FX Academy and you'll be good to go. I guarantee you your stop losses will not be getting hit as much, if it ever does, for the most part, after reading this book and going through this book. All right. Ultimate stop loss. Let's get to it. So since we're going over stop loss, we got to go over the setups first. Now, before we even do that, first thing we want to do is go over our rules, right? Rules. All right. Trading 101. Stop. Okay. You want to stop losing, right? Stop loss. Oh, yeah. Stop losses. Okay. We want to stop losing. So, with that being said, first thing, when you are trading, you have these rules that you have to follow. And number 4, let me do this again, one by one. Rule number 1, time frame, as far as your technical analysis. What time frame is this setup coming off? All right, here are your time frames. You either using the monthly time frame, okay, or the weekly time frame, or the daily. These are your 3 time frames that you will be using for your technical analysis, as far as what time frame is my setup coming off. Okay. Number 2, the time frame that we use to execute our trade, the time frame that we use to enter our trade. Okay. So rule number 2 will be the time frame that we use to enter our trade, and that will be the H4. Okay, which is the 4-hour time frame. Okay, that is the 4-hour time frame. All right, 4-hour time frame. H4, 4-hour time frame. It's the same thing. Now, with rule number 2, all it means is, with the rule number 1, you have your either double bottom, double top, breaking retest of some sorts based off either the monthly, the weekly, or the daily time frame, right? And then you will drop down to the 4-hour, which is rule number 2, the 4-hour time frame, to wait for your to wait for your setup itself. Basically waiting for the market to come into your zone before executing your trade, right? So while you're in the 4-hour time frame, rule number 2, number 3, okay, rule number 3 falls in line. Now, rule number 3 is your reason, your confirmation for entering the trade, for executing this trade, right? For the buy or for the sell. In the case of this, for the buy. So what we're talking about is price action, okay? Rule number 3 is price action, which is the engulfing. So let's go ahead, right? Price action, right? Rule number 3 is price action, okay? Now, the price action we are using is the engulfing bar, right? The engulfing price action. All right. In the case of this, it will be the bullish engulfing, okay? Oof. It will be the bullish engulfing. That's rule number 3. So let's go ahead and put the last one in there. Let me minimize this real quick. I made this big enough that way you could see it. All right. All right. Back to this. So rule number 4 is after we enter our trade, which is what we're going over today. Rule number 4 is your SL. Okay. Your stop loss. Okay. Rule number 4 is your stop loss. All right. Rule number 4 is your stop loss after you execute, right? After you pull the trigger in your price action, bullish engulfing price action, right? You want to place your stop loss. So rule number 4 is your stop loss. And that is what we are covering today, where to place your stop loss. So let's go ahead and get into it. Now, we have different variations of that, of course. Now, first thing we're going over is we have a bullish trend. How do we know that we have a bullish trend? It's very simple. When we are trying to identify the bullish trend, just so we know, this setup right here has to be, okay? Has to be based off the higher time frame. So let's throw these in there real quick. Monthly, weekly, and then daily. And then don't forget, we have to use H4 for entry. And then for PA, price action, it has to be the engulfing bar, right? Engulf. So we need these in there. So this higher time frame setup is either based off the weekly, daily, or the monthly time frame. All right. So back to the structure. Okay. Now we know we're looking for a buy. We know we're looking for a break and retest. We know we have to put a stop loss. We know we need a price action. This is how the market look like right now. To understand that we have a bullish market, we need to identify the structure itself. Now we know this is a bullish market, right? Because it's giving us higher highs, okay, and higher lows. So I'm gonna go over this really slowly, real quick. All right. When you go to the chart and you want to identify the overall trend of the market, you want to look at market structure itself and start marking them. And how you mark them would be higher highs and higher lows and lower high based on the trend of the market, where it's going. If it's a bullish market or a market itself that is buying or that's going up, right, it will give you higher highs and higher lows. So let's throw that real quick in here, right? So a bullish market, okay, bull market, will give you higher highs, okay, and high lows. That's when each high is higher than the previous one, where each low is higher than the previous low, but it's lower and lower, right? So let's mark it out real quick to make it a bit easier. So this is an uptrend market. So these will be your higher highs, okay? Let's make this a bit smaller. That way we could really throw these higher highs in there. Yeah, that works. All right, so bullish market, we get higher highs where each high is higher than the previous high. Okay. And after market give you a higher high, you already know you get a high low. Okay. Like so. So we know we had a bullish trend. At this point here, market consolidate within here. So all this is the same low point. It's the same high low. And then eventually market did give us a bullish engulfing, as you can see here. This right here would be considered as the last bearish candle. This right here will be the bullish candle. That engulf, as you can see, it closed above it. Here would be where you pull the trigger based off multiple hit to this bottom point here. Okay. But the setup we are looking for is the retest. So we got two retests, right? Now, market did clear this consolidation and also broke the previous higher high, which is here. As you can see, it broke that right here. When it went through that, it broke the previous higher low. The previous higher high to give you a new high. That's higher than the previous one. So we got a new higher high. Once market come back to retest, right? To retest this structure point, a previous higher high. Now we have a high low. Now, at this point, we have a bullish engulfing, right? This is the first price action. If you start trading, you will learn about. It's a one candle price action where it's only one. It took one candle to engulf the last selling candle. Okay. Now, just like before, let's throw a little color. Boom. Right. You can see here. That's where the last bearish candle started, and then above here is where at this point it got engulfed. Here would be your entry point. Okay. That will be your entry point. Now, the most important part we're looking for, that's what we're going over today. Stop loss. Now, we're going to go right back to this lesson real quick. Now, when it comes to stop losses, okay? When it comes to stop loss, for a buying market, let's just put for a buy. So when you buy the market, right, you always want to place your stop loss at the last low. Okay. So if we have market going up like so, giving you higher highs and a higher low, right? When market come in break and retest and it give us a PA, aka or price action at this point, when it come in retest that after we enter with a price action, we looking at this structural low point for our stop loss, right? That's where our stop loss need to go. Now, of course, we have different variations of previous low. That's why I have different setups. That's from the book itself that we're going to go over to give you a better understanding of how it will look like when you are taking your trades. So back to this. We have a breaking retest, as you can see, and then we have a single bar price action where we got one bullish engulfing here. Now, once we enter here for a buy, we're looking at the next structure low, the previous structure low, and which would be the high low, right? The previous low point that the market gives you before it went up to give you that higher high. Okay, that's what we're looking at. So when you enter here for a buy, you're looking down here, okay, for your stop loss. Plain and simple. And when you trade like that, your emotions are not involved. All the feelings are out of it. No guessing. So you're just simply reading and reacting to what the market giving you. As long as you're not over leveraging, you should be just fine. Okay. As long as you're not over leveraging, you should be just fine. So I'm gonna run it back one more time. Okay. When you are buying the market, regardless if it's a break and retest after a double bottom, right, or a double bottom itself, after you pull the trigger with a bullish engulfing, you want to look at the previous low to place your stop loss. Okay. After you pull the trigger, you look at the previous low to place your stop loss. No guessing, no hopes, no fear. All right. No emotional involved. Just look at the last low and please place your stop loss. All right. So just like so, once you enter here, you place your stop loss down here. All right. And then, of course, we target the next high. Now, that's the first break and retest of structure. And then we're looking at a bigger break and retest after the market itself continue going bullish. As you can see, it came back down to retest that same zone point where market was either ranging or consolidating, right? However way you choose to see it. Really, it's a consolidation. But if you're looking at it on a monthly time frame, depending how big each high and low is not so much of a consolidation where you could take the buy from the bottom since you're going with the overall trend, or you just leave it alone. I will be going over that also on how to trade these type of setups. Pretty much here is what you'll be waiting for. You normally wait for a breakout, which was this right here. Market breaking above this and then coming back to retest. So break, retest, bullish engulfing, previous structure low, which is the previous high low. Okay. And then you take that buy, you put your stop loss accordingly. Again, no emotion involved. Now, market came back again to retest that same structure zone, right? Once market come back to that zone, as you can see, we have the single bar of price action, which is the bullish engulfing, where it just took one candle to engulf the last bearish candle. Now, just a little touch up on the price action itself. The reason why you want to choose, the reason why this is the price action that works 95% of the time is because it does what it says. A bullish engulfing is pretty much when bulls have engulfed sellers, buyers have engulfed bears. Okay, so the bull market have taken over. Bullish engulfing, I have taken over, just like the forest, right? If you light a fire in the forest, eventually, as the fire spread, it will engulf the forest. It will overtake. It will take over. So when it comes to trading itself, all you're waiting for is for the buyers to engulf, for the buyers to take over. So at a critical area, at a zone level, when market give you that specific price action, right? So price that is at that level, it's time to take that action. Once they give you that bullish engulf, and as you can see, it closed above it, you pull the trigger right here at the close of that. And again, you're looking at the previous structure low, which is here. Once you pull the trigger, that's your entry point. Okay. And then stop loss goes down here like so. All right. And then you target the next structure high. Of course, through the process, you are respecting every infrastructure the market give you. See that? Straight to the point. So this is one variation of a stop loss placement with a break and retest. All right. So this is setup number 2. All right. Same thing like before. This setup has to be based off a higher time frame, and that higher time frame has to be either a monthly time frame, a weekly time frame, or a daily time frame. There's no if, there's no but, right? And then when it comes to your entry point, it has to be within the 4-hour or the H4. It's the same difference, right? The 4-hour time frame, and then your price action, right? The reason you're executing your PA is the engulfing, okay? The engulfing bar. Engulf bar, right? The engulfing bar. Just like its name, you wait for buyers just simply to engulf the last selling candles, or you're waiting for buyers to engulf sellers. Now, of course, we're going over different variations of that, right? Now, here we have a double bottom, right? So we had a selling market, right? We had a bearish market. As you can see, market came down, boom. This right here was the last bearish candle the market give us. Now, this bearish candle give us an extended wick, as you can see. That's the wick of it. And then this is where it closed at, all right? Now, the bullish candle started down here. Of course, it went down, giving you a little wick, and then it went up, okay? Now, when you look at it, it could look a bit even, right? Cool. But guess what? The next candle that the market gave us was a bullish candle. So in the case of this right here, right, the market gave us 2 bullish candles to engulf the last bearish candle. So again, here would have been your entry point, and then that's where your stop loss would be. Okay. Now, since we're talking about a double bottom, so this will be considered as the first bottom part, right? It stops here and it went up, went from a bearish to a bullish. All right. Very simple. Now, eventually, the market did come back down, going bearish again, and it came back to a zone. So remember, we marked this zone here. We created this area because market give us that level. We simply marked it because it stops here and it went up. Now, we mark it for when it comes back to it. Okay. So remember our rules, right? Always look to the left. So when the market give you a setup, a double bottom break and retest, just look to the left to see what the market did last time before it bought up. That way you could anticipate, right? You're going to anticipate for when and if the market give you exactly the same thing before it bought up last time, right? Once it gives you exactly the same thing, you will take that to go up. Okay. In the case of this, we had variation number 2, right? So we do have that, the all 5 different variations available in Amazon now, okay? Royalty FX Academy, the ultimate price action, all 5 different variations of price action that you need to learn to understand so you could buy the market with precision. All right. So we got one variation here. So a 3 candle variation where it took 2 bullish candle to engulf. Now, market came back, right? After it gave that one hit down here and went up, it came back like so and hit the zone. Okay. It came back like so and hit the zone. Now, all we have to do is just simply look to the left, like before, right? See what it did last time. We look to the left, see what it did last time, and then we're just gonna simply read and react to that. There's no if, there's no but, no emotion involved, right? Now, we know last time the market gave us a 3 candle price action where it took 2 bullish candles to engulf the last bearish candle before it bought up. Okay. Now we know that's one of our variations. So here it give us 1 candle, right? So we have the 1 candle price action, right? Where it took 1 bullish candle to engulf the last bearish candle. Here, okay, that is the last bearish candle. You could see, let's get this in here, right? You can see that right here. It closed above it. Right there would be your entry, okay? See, it closed above it. You can see it. Right here, up there would be your entry point. So you enter here for your buy, okay? You enter in there for your buy, and then your stop loss got to be at the last low. Now, you look to your left because you're looking at the previous structure low so you can put your stop loss, but you don't exactly have a previous structure low. So now you're looking at the wicks, right? The wicks as far as the lowest the market I had ever went last time. So when you look at it after you enter your trade, this is your last low. Okay. That's where you place your stop loss. All right. No if, no but. Just simply read and react. And after, of course, after you enter your trade, you go away. That's a 4-hour trade. So there's no need to sit there and watch it. Goes come back 4 hours later, as you can see. And then boom, for the market to go up. Of course, you targeting TP1s and TP2, so on and so forth. Because you got to respect every structure that the market gives you for what it is. Okay. There's no if, there's no but. You just simply reading and reacting. As long as you're not over leveraging, as far as taking too big of a lot size, you should be just fine. Okay. You should be just fine. That I guarantee you. Okay. There goes different variations of that where we do have a double bottom, right? So we had a bearish market, right? Boom. Now, this would be a textbook consolidation. Why? As you can see, you get a you get a bearish candle. That was the last selling candle. And then you got a bullish candle. And then you got a bearish candle. And then you got a bullish candle. Notice all of them are about equal. There was no big movement in between. Okay. That's why I did it like that. Where the last one, I created the infrastructure. I created a structural point where you had the highs and the lows where you could buy in between or sell in between. You could sell it at the top and buy it at the bottom. But here would be a textbook market consolidation, right? Because the candles basically will look like this. See that? No place to move to, right? And then your buy would be at the retest point. You see right here? That will be the retest point because market breaks above. It broke above and then it came back to retest. Here would have been your entry. Okay. But we know market did give us a bullish engulf. And with the last bullish candle, it closed above the last bearish and it went up. No if, no up, no but, right? So because market did this, we simply generate a zone. Okay. This yellow line right here is our zone. We just placing it. That's all it is. It's just a zone. That zone is placed there simply because market was at that point and it shot up. So we mark that area for winning if, okay? The zone is placed there because market was at that point, okay? It was at this point, it stopped, it went up. It stopped selling and it went up. We just marked that area. It's just a zone. No need for any names. The reason we place the zone is for when and if the market comes back to that zone. Okay. When and if the market come back to that zone, we're going to look to the left. Okay. We always look to the left because we're looking at the past, right? We look at the past so we can have a better future. You always want to look at the past, study the past. Okay. You look at the past so you can have a better future. So you look at the past to understand what it did last time before it bought up. And then you are looking for it to do something that resemble what it did last time. That way, once it does that, you can now go ahead and join the market and its process going up. So it is not our job to say that the market is about to buy or it's about to sell. No, it's not our job. Okay. Our job is to simply read and react to what the market gives us. All right. So now, like before, we have a 3 candle price action where last time when it bought up off this zone, we had a 1 candle price action, 1 bullish candle that engulfed the last bearish candle, which would be this one right here. Okay. It bought up. Now, this is the last selling candle that hits that zone. Please remember, right? This setup is happening in the 4-hour time frame. Okay. It's happening in the 4-hour time frame. So let's just say, let me show you the little cheat sheet, right? If this candle right here started exactly at, let's just say 5, right? This candle right here started exactly at 5 p.m. Okay. That candle would close at 9 p.m. Right. So that's the time that 4-hour candle will close, right? Once that 4-hour candle close, all you got to do is wait 4 hours later, which would be for this candle right here. That would have been available for you exactly at 1, right? So if this is 9, right? It started at 9. I mean, it started at 5. I'm sorry. This candle started at 5 from 5 p.m. and it closed at 9. And from 9 p.m. to 1 a.m., that's when this bullish candle will close right there, right? You see how you don't have to sit there. All you got to do is just wait. That bullish candle could have engulfed the last one, which means at 1 a.m., you would have just clicked buy and go right back to sleep, right? But due to the fact that it gave you a bullish candle that did not engulf the last bearish candle, there is no buy for you to take. So all you got to do is just literally go right back to sleep, right? And then you're going to wake up again at 5 a.m. To be more specific, you want to wake up like 5 minutes before 5 a.m. That way you have a little time to wake up, get yourself together. But, right, this candle right here would have been closed at 1 a.m., right? When you wake up again at 5 a.m., this candle right here would have been available to you, right? So this is a 2 candle price action. So again, another different variation, right? Here is where you would pull the trigger. Oh, sorry. I want you guys to be able to see it as I mark it, okay? Right there, right here would be your trigger, right? You pull the trigger. So you see it went above it to close, right? So right here is where you enter the market, okay? That's your entry point. You enter the market for a buy, and then you're going to look to the left. You're looking at structure low, the previous low that the market give you, so you could place your stop loss, your SL, right? Now, when you look to the left, you don't have a structure low that's lower than this current low. This last bearish candle, this is the wick. That's the lowest it went. When you look to the left, you don't have any wicks or any lower point that's lower than this. So with that being said, you have to use this. Once you enter here, let's change the color. Once you enter, you're going to place your stop loss at this low point. That's it. No if, no but. Literally, that's it. Okay? Different variations of double bottoms where you will learn to understand how to properly place your stop loss, because not every previous low is going to look exactly the same. Okay? Now, let's go to the next one. All right. Now, in the case of this one, we have a